Hello, good morning to all and happy Friday. Welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Happy Friday and good morning. Today will be the 26th of April. Yeah, today will be the 26th of April 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the markets today in terms of the short-term technical outlook, it's been a very interesting volatile movement in the last 24 hours given the state of the markets in terms of the news releases as well as the data, which I'm going to highlight to you all today right now before we jump straight into a technical analysis of the broad bit of the cross asset classes. So in terms of data release up from US, we do have a very important data release will be the Q1 GDP number and as well as the quarterly CPI inflation number for the US. So in US over here, yesterday we do see a slight downtick in terms of growth, came in below expectation. So let me immediately flash to you the economic data so that you guys could see on the screen over here. Okay, so yesterday, yeah, GDP growth. Okay, let me expand it so that you guys could see. All right, good. Okay, so what you could see over here is that the advanced growth rate in terms of the GDP number. So what it shows over here, right, in terms of the Q1, the growth rate, this one over here. Okay, so Q1Q actually came in at 1.6%, way below consensus of 2.5% and below the previous month of 3.4%. All right, so not previous quarter, pardon me, previous quarter, that means Q4 last year. So if you look at the trend of the flash US GDP Q1Q data, so if you look at the last 3 months, it has been slowly in a mode of deceleration versus the previous 2 quarters of 3.4% and 4.9%. All right, and also because this is a quarterly thingy, the department also releases the quarterly Q-on-Q inflation data. So they actually measure it by PCE. Okay, the PCE data. So if you look at the PCE Q-on-Q data over here, it actually increases to 3.4%, 3.7%, pardon me, 3.7% in Q1 this year versus only 2%. That is the Fed funds, the Fed target rate of 2%. It managed to hit in the previous 3 months, means Q4 of 2023, and also came in slightly above expectation of 3.4%. So if you look at the trend, this is a quarterly basis or not the monthly basis. Okay, so if you look at the quarterly basis over here, the inflation trend for Q1 this year has kind of re-accelerated up again. Okay, if you look at the past 2 months. So the key thing over here is the story is that if we could recall those who actually I shared with you in my daily dose of market insight, is that inflation expectation has started to pick up as well in the last 3 weeks or so, and inflation expectation are more of a leading element. Why? Because they actually implies to us what is the 10-year inflation rate like will be in US from now, given on a market-based break-even rates derived from the US Treasury inflation expectation. And given that this is a lagging one because this is based on last 4 months ago Q1, there's actually a risk right now that the US is actually facing stagflation environment. That means, i.e., a slowdown in GDP growth, means economic growth, has been evidenced by the flash Q1 GDP data that I shared with you, and inflation getting much more stickier and elevated. So that actually explained to us that that Fed dovish pivot at the start of this year has started to get evaporated, and we may start to see a rise in the US 10-year Treasury yield going forward. Okay, before we jump straight into the US 10-year Treasury yield trend, let me share with you what is this leading market forward leading inflation expectation data that I'm monitoring on. So if you look at my chart over here, let me expand my screen. Okay, so, okay, correlation tool. Okay, give me a second for the chart to load up. Okay. Oops, not this one, not this one. Yes, this the one. Okay, so I want to monitor the orange line and the dark blue line together with the green line, which is WTI crude oil. The orange line is a 10-year break-even inflation, and the blue line is the 5-year break-even inflation. You look at these three lines, the green, the orange, and the blue line, they actually move hand in hand together. That means in direct synchronization. A rise in oil actually give rise in the 10-year break even and the 5-year break even. So this 10-year break even and the 5-year break even is, think about it as an implied inflation expectation 5 year from now and 10 year from now, and it's been slowly inching upwards since the start of this year. So right now they are trading at 2.4% and 2.4% each. All right, so holding rather stickily high above that 2% inflation target detected by the Fed, that the Fed wants to drive down inflation. And if you look at the Fed funds rate, which is in gray line over here, and you realize that the Fed fund rate starts to hike in 14th of March 2022, and before the Fed start hiking the policy rate, you notice that this tree line, the oil price, the break evens, the 5-year and the 10 break evens actually rose rather steeply first before the Fed start rising over here, because inflation expectations starts to get anchored on the upside. So what causing the Fed to actually hold back their interest rate cut cycle is because of that rise in the US 10-year break-even rates, because they are afraid that, i.e., it will actually lead to a higher inflation expectation be anchored on the upside. So they are actually boxed at this point in time. So perhaps they may not even cut this year, given the fact that market is still hoping pricing of an interest rate cut, only one, in the month of September. So it's been right now pushed back. Earlier we're talking about March, then March become June, and right now is penciled in September. And also, given the state of the current inflation data, notwithstanding that later there's a key data to look out for, which is the monthly PCE data, not the quarterly. Yeah, yesterday they released the quarterly one, Q1. So today they will release for the month of March. So if this data gets rather elevated as well, perhaps the Fed will start to give a new guidance during next week Fed Chair Powell press conference after the FOMC meeting. They may start to push down the calendar to perhaps only in somewhere around in November or December FOMC meeting, then they enact their first interest rate cut. But what does it mean for the market? It means a rather steep rise of that 10-year US Treasury yield in purple line over here, looking to potentially retest the level seen in September. So if you look at the trend of the 10-year US Treasury yield, okay, over here, where do I want to have it? Okay, it's been inching upwards, and yesterday it printed a higher high, a very obvious higher high, okay, above the 4.5% former medium term pivotal resistance, now turns into a pullback support. All right, so right now it's trading within a major long-term circular ascending channel that is in place since March 2022, and the top of that channel is at 4.2%. Okay, so momentum is still positive or bullish. Why? Because there's no bearish divergence that's being shaped at this juncture on the daily RSI. So persistent uptrend that's been seen in the US 10-year Treasury yield, it actually implies to a higher cost of funding, and worse still, growth has starts to slow down as depicted by the flash number of the Q1 US GDP that I shared with you earlier. Stagflation risk environment has starts to go up by a notch, and that actually doesn't bode well for risk assets. So we start to see a throughout sell-off in the major US stock indices. The SPX is down negative 0.46% yesterday. The Nasdaq down negative 0.55%. The Dow Jones down almost negative 1%. The Russell 2000 down negative 0.7%. But what's interesting over here is that given that today's is still a this week is still a earnings week announcement on key US technology stocks, especially the Magnificent Seven, which has a very significant weightage in the SPX and the Nasdaq 100. So earlier today morning, we see another two Magnificent Seven stock release their earnings, which is Google, that means slash Alphabet, and Microsoft. And Microsoft bearing that they are actually the biggest weightage stocks, component stock in the SPX, ranked number one in the SPX and the Nasdaq 100. So Microsoft actually beat earnings, over here. It came in at 2.94% EPS versus 2.82% expected, and market like that. And given that the rosy guidance is quite well received as well, the share rose as much as 5% in the after hours trading. So what is after hour trading is the close of the US session yesterday, and the most sterling return was Microsoft, Alphabet, Google's jumped by 14% on the earnings beat, and most importantly, it declared a first ever dividend. All right, so market like that this news, and it actually drove Apple share by 14%. So what you see over here is a lot of related to firm-based positive news flow that outweighs the current longer term or medium term weak macro factor that is actually supporting more of a negative outlook on the major US stock indices. So the Nasdaq 100 and the S&P 500 in the futures market today, they actually rallied, okay, in the Asia session. The Nasdaq rallied by 1%, and the S&P E-mini futures rallied by positive 0.8%. So later I'll share with you the short-term technical outlook on the Nasdaq 100. All right. And also one news I want to share with you all for today, very important, is related to Japan. So in Japan over here, right, the Tokyo inflation data. So the Tokyo is considered as a leading Japan nationwide data that they released 2 weeks earlier before the nationwide Japan CPI. So they actually released for the month of April, all right, April. So for the month of April, the one that is excluding food and energy actually dipped down below consensus. It came in as a shocking number of 1.4% year on year, below consensus of 2.7% and below the previous month of 2.9%. Okay, so if you look at the trend over here, okay, it's quite shocking. So if you look at the 5-year trend, okay, so it came down at 1.4%, and bearing in mind that, do not forget, in the last couple of months, Bank of Japan officials have sounded pretty confident that the inflation trend, that means excluding food and energy in Japan, is more or less in a firm footing, holding above at that 2% plus. That means, i.e., they're pretty much confident that Japan starts to exit out from their deflationary risk spiral that is inflicted in the Japanese economy decades plus ago, since 1999, after the bursting of their property bubble. But given the latest print of the Tokyo CPI X food and energy that went below the target of 2%, and it stood at 1.5% the latest month. So this is the lowest level pace of increase since December 2022. So that actually will actually be a bit complicating in terms of the timing of the next BOJ interest rate hike. Do not forget that in March, BOJ has already exited from its negative interest rate policy and scrapped the 10-year JGB yield curve control program because of their confidence of the Japanese economy maintaining inflation growth trend at around the 2% level. But given today's latest print of below 2% at 1.4% for the Tokyo core CPI data that is excluding food and energy, the meeting later on, BOJ meeting is actually today. Market is expecting no change. So during the press conference, that's going to be at the close of the Japan stock market. So that's around 2:30 p.m. and 3 p.m. Singapore time. Between this time period, I do reckon that during this press conference, BOJ Governor Yoda will be pressed to actually address this rather shocking soft Tokyo CPI print number. Is it a new trend or is it just a outlier? That BOJ is still confident to normalize its interest rate policy by enacting another interest rate hike before 2024 ends. So market will pay attention to the timing of the guidance of the next interest rate hike, because before this soft CPI Tokyo numbers, market do have a relatively optimistic expectation that the next interest rate hike could come in as early as the July BOJ meeting. But with this soft Tokyo print number, that July meeting may not be live. But for sure, what we could see right now is a further support of dollar strength against the Japanese yen. Okay, because yesterday the Japanese yen going to print higher, and let's see right now, is it has BOJ released its latest guidance, all right, or latest BOJ policy meeting, because it should be out now pretty soon. Okay, so it seems to me that there's no news yet that is out. Okay, let me go to this website. Okay, called Forex Live. Okay, let's see whether BOJ announcement is out yet, because usually it should be out around this timing. Okay, around 11 a.m. Singapore time to 11:30 a.m. Singapore time. Okay, it's running. It's a bit slow right now. Let's see. Okay, it seems to me that, okay, let's do a quick check, because my internet is a bit slow right now, because I think it's still not out yet. Okay, let me refresh it. Yeah, it's still not out. Okay, looks like it's still not out. Okay, so with that, right, that is the key data I'd like to share with you all. So now let us straight away jump straight to the short-term technical outlook on the FX pair first. So starting with the dollar yen. All right, so for the dollar yen, let us immediately go to the short-term chart, the dollar yen. So the dollar yen continue to remains pretty resilient over here. So yesterday we do highlight a first resistance to watch in the short term is that 155.70. Okay, let me expand my screen so that you guys could see. Okay, 155.70, then thereafter it traded sideways while awaiting for the BOJ announcement, and as well as the release of their quarterly outlook report that is also out today as well. So market participants will be pretty much fascinated about the outlook report on the inflation number. So market is expecting an upgrade, a slight upgrade to this year inflation projected number at 2%, and next year also be at 2% from 1.9% penciled in the last 3 months. But would there be any big changes? Possible. Why? Because of that soft Tokyo CPI print that I highlighted to you earlier on. But nevertheless, the trend over here is still pretty much intact. So first support level to watch, right, just in case if there's any volatile movement, will be at 155.20 level. Okay, this level here, 155.20. But I don't want to actually tighten the short-term pivotal so much to 155.20. Still maintain at 147.70. 154.70, pardon me, 154.70, which is the very clear minor congestion zone over here that has been broken out on this Wednesday. Okay, so no change, 154.70, as long as any potential pullback, minor pullback didn't break below 154.70, still maintain that short-term bullish bias on the dollar yen. Next resistance after 155.70 will be at 156.30, followed by 156.70, close to the top of the upper limit of this ascending channel from the low of 5th of April, and as well as a Fibo extension cluster level as well at 156.70. only an hourly close below 15470 will kind of invalidate this short-term bullish bias to kickstart a much more deeper corrective pullback to expose the next near-term support level at 15390, followed by 15330, which confluence also with the upper limit, the upward sloping 20-day moving average. Aussie dollar. So Aussie dollar, no change, going to trade sideways below our predefined short-term pivotal resistance that we have, 65.45. And what's interesting over here is that the hourly RSI has started to shape this bearish divergence, and it's going to print lower high below the 50 and the around, because price is now testing the 50 and the 200-day moving average. So no change, still use that 65.45 as my short-term pivotal resistance for today. Still maintain that short-term bearish bias on the Aussie dollar. First support level to watch for today will be at a higher level, which is yesterday's US session low. Okay, at this 64.85. A break below 64.85 exposes the next near-term support at 64.60. All right, only hourly close above 65.45 will invalidate this short-term bearish bias to see a squeeze up to expose the next resistance zone of 65.90 / 66.10 congestion area here, and also the minor descending trend line that I drew from the high of 8th of March. European currency. So the European currency, the sterling dollar, yesterday kind of trade higher, whipsaw around it, but then thereafter it can't break above the 25.20 short-term pivotal resistance that we highlighted. So also the 20-day moving average as well. Okay, this red line over here, the 20-day moving average. This is the 20-day moving average that it was tested and can't break above. So still no change, still using 12520 as my short-term pivotal resistance to maintain that short-term bearish bias. Except that I do have a higher resistance level, a higher support level to watch today, which is yesterday's US session low, which is at 2460. Only a break below 2460 exposes the next near-term support at 123.90 on the sterling dollar. However, an hourly close above 12520 will invalidate the short-term bearish bias to see a squeeze up for the next resistance level to come in at 12570, 12640, which confluence with the 200-day and the 50-day moving average, and as well as this minor descending trend line that I drew from 8th of March. Euro dollar. So euro dollar kind of tested the 20-day moving average as well before coming down. So it's a bit of excess. 0725 / 0740 will be my short-term pivotal resistance for today. 0740, a bit of excess over here. Still maintain that short-term bearish bias, but with a first support level at a higher level to watch, which is yesterday's US session low at this 1.0680. A break below 1.0680 exposes 1.0640 next on the euro dollar. However, an hourly close back above 1.072 1.0740 invalidate this short-term bearish bias to potentially see a squeeze up towards the next resistance level at 1.0780, followed by 1.0820, which confluence with the 200-day and the 50-day moving average, and as well as the 61.8% and the 76%, 76.4% Fibo retracement of the last push down from 9th of April to last Wednesday's minor swing low, 17th of April swing low. All right. Then now, what's next for the? Okay, let's look at the pair. I think the news is, yeah, it seems to be that it's coming out already. The data seems to be out. Yeah, so it's still bullish. It's now testing the 155.70. That's the dollar yen. Okay, so later we'll revisit again. No change on that. So very quickly, let us jump straight to the major indices. So the major indices over here is, let's take a look at the Japanese. Okay, so no change for the Japanese 225. So the Japan 225 yesterday hit the support level, and right now is shipping a bounce back again over here. So as long as this pivotal resistance at 36 640/80 holds, we will still maintain that short-term bearish bias on the Japan 225. But with that, I do have a shorter-term support level to watch out for today. So it is something like a trigger level, which is today's Asia session low at 37,570. All right, a break below 37,570 exposes the next support level to watch. We're at 37,007, 36,650 next. Only an hourly close back above 38,800 level over here, the short-term pivotal resistance level, also conversing with the downward sloping 20-day moving average, will expose the next resistance area at 39,390, 39,810, okay, which confluence with the minor swing high of 9th of April and 12th of April, and as well as this minor descending trend line that I drew from 21st of March. Okay, over here, so still no change. Okay, Hong Kong 33, the Hang Seng Index, okay, now is actually testing the medium-term pivotal resistance at this 17,600 level. All right, so it's kind of but there's this bearish divergence that's being flashed out. So with this bearish divergence that's being flashed out, right, do not have any confidence to actually see a direct push up from here. So still kind of having a neutrality stance between this. Okay, so I'll turn neutral over here because it just could be a bit of noise. Okay, at this higher. Okay, this slightly above this 24th of November minus swing high. Okay, so I do a slash. Okay, because of that bearish divergence, I don't want to do outright bullish. All right, so neutral between 17,600 and slash 17,685 over here, and the lower limit of that neutrality range will be the 200-day moving average, and also today's Asia today's Asia session low as well at 17,290. Okay, so neutral between these two levels, 17,600/65 and 17,290 for the Hong Kong 33 index, okay, which is the Hang Seng index. Pretty much a mixed bag. Why? Because there's this bearish divergence that is still prevailing on the hourly RSI. Okay, now, for the German 30, so the German 30, which is DAX. So yesterday DAX we flipped to a bearish bias. So it almost hit the support level, the first support level at 17,840, which is the 50-day moving average before shaping that bounce. So with that over here, the RSI also managed to actually exit out from the oversold region. At this point in time, it exit out oversold region. So now it's trading in around the 50 level, middle part of it. So with that, right, it's this bounce here. I do not want to actually turn bullish for this counter trend rebound because the price will really lift a fair bit from the support level. So it's the middle of nowhere. So I would rather use this push up over here for the next first level of support to watch will be at the first level of support resistance to watch will be at 18,160. Then for sure the pivotal resistance still remains at 18,310. Okay, so as long as 18,310 didn't surpass on the upside, we will still maintain that potential bearish bias short term on the German 30. First support to watch over here will be 17,840. A break below it exposes the last Friday minus swing low at 17,550. Okay, only an hourly close above 18,310 will invalidate the short term bearish bias to see a continuation of that push up to expose the next resistance level at 18,400, followed by 18,490. Okay, US major indices, let's start with the Dow Jones Industrial Average, US Wall Street 30. Okay, price action came down and almost hit the support level the second support level at 37,690, right? 37,690 over here. So still no change. Okay, so price action is still a bounce. So first resistance to watch for today will be yesterday's minor swing low. Okay, at this level here. Okay, which is 38,365. Okay, but I do not want to put it so tight at 38,365. I still use the 38,590 as my short-term pivotal resistance, which is also close to the downward sloping 20-day moving average. So still no change as long as price action didn't surpass 38,590. Still maintain that short-term bearish bias on the US Wall Street 30. First support level to watch for today will be at the 37,690 level, which is close to yesterday minus swing low. A break below this level exposes a last Friday minus swing low at 37,390. All right, this level here. As long as this level holds. Okay. However, a break above 38,590 will invalidate the short-term bearish bias to see another round of counter trend rebound scenario unfolding on the US Wall Street 30. Next resistance to watch after 38,590 will be at 38,930, which is confluencing with the minor swing high of 8th of April and 10th of April, and as well as the close to the golden ratio of that 61.8% Fibo retracement of that previous down move from 1st of April to 19th of April. Now, Nasdaq 100. So Nasdaq 100, this was the squeeze yesterday. It hit the support level at 17,185 before bouncing up boom over here. All right, so due to that strong after hours price action rally in Microsoft and Google Alphabet. So still no change, still using the 17,690. That will be my short-term pivotal resistance over here. Okay, so as long as this level didn't surpass on the upside, we'll still maintain that short-term bearish bias. So first support zone to watch will be at the 17,290 slash yesterday's US session low with 17,185. Okay, so this is the first support level to watch. Only a break below 17,185 exposes last Friday swing low area at 17,030. Only hourly close above 17,690 will invalidate this short-term bearish bias to see the continuation of this counter trend rebound scenario to unfold. Next resistance it may expose to will be at 17,810, followed by 17,960, which confluence with the 50-day moving average acting as a resistance, and as well as the Fibo retracement of the 61.8% and the 76.4% taken from the previous down move of 12th of April to this 19th of April, which is last Friday. Okay, that's for the major stock indices. How about that spot gold? So spot gold, no change. Still looking at the 2,300 short-term pivotal with support level. Now it's still hovering around the upward sloping 20-day moving average. So as long as this 2,300 short-term pivotal support didn't surpass to the downside for XAU/USD, that's gold still maintain that short-term bullish bias. But first resistance to watch, it got to surpass will be at 2,365 before exposing the recent minor swing high of 12th of April and 19th of April, acting as a next near-term resistance at 2,420. However, an hourly close below 2,300 will invalidate this short-term bullish bias to see the extension of this ongoing minor corrective decline to expose the next support area at 2,265, 2,235, and even 2,207, which confluence with the upward sloping 50-day moving average. Okay, so lastly will be the West Texas oil over here. Let me open up the West Texas oil for you guys. Okay, so for West Texas oil, so if you look at the daily time frame chart over here, the trend is still very, very bullish. Look at the nice little curvature of bullish candlestick that's being formed after the test of the 50-day moving average and also the 80-80 short-term pivotal support level that we've been highlighting since the start of last week, start of this week, pardon me. All right, so all in all, right, still remains a bullish bias in the short term for West Texas oil. So with that, we'll be using the 80-80, still no change, as a short-term pivotal support for today. Unless it starts to clear above 84.40, then I could tighten it to yesterday's swing lower at 82.60. Okay, but it's still playing around at the 80.40 short-term, near-term resistance level. Okay, but it hasn't have a clear break yet. So still no change. Still use 80.80 short-term pivotal support. 80.40, 84.40 breaks out, exposes the next near-term resistance of 86.35 for today. So that's the minor swing high of last Friday and the last Tuesday, 86.35. Okay. However, an hourly Sunday, if we see a erupt hourly close down below 80.80, then this short-term bullish bias will be kind of evaporated to see the extension of this ongoing minor corrective decline back down towards the medium-term support zone at 78.40, 78.80, 78.40 next. Right, so still maintain that short-term bullish bias on the West Texas crude oil as long as 80.80 short-term pivotal support holds. Okay, now let's take a look at the dollar yen. What's going on in dollar yen? I believe that the BOJ has already released their stuff. Okay, so dollar yen remains bullish over here. Okay, no change. So with that, right, given this strong push up right over here in that dollar yen above 55.70, so my short term pivotal support level, I would tighten it to this level here at 155.20 instead. Okay, so I tighten it to 155.20. Oops, what the hell is it? Okay, let me copy it. Okay, 155. Okay, so this will be the normal support. Okay, so as long as this 155.20 holds, which is correspond to the lower limit of this minor descending channel from the low of 5th of April, still maintain that short-term bullish bias on the dollar yen given this short move here, breaking above 155.70. Next resistance 156.30, followed by this 156.70 next over here in the short term. Okay, all right. Then now let's quickly take a look at what's going on in the fundamental things of the dollar yen. I think, yep, unchanged. So same thing, no change, right? Pretty much nothing to see also. Okay, so what you see that over here, okay, vote was 9-1, blah, blah, blah. Okay, so he's mentioned that there's extreme high certainty on Japan economic outlook. Okay, so but he still expect the long-term inflation expectation to heighten moderately. Okay, more firms starting to pass on rising wages, so that's pretty much in line. Okay, so let me see whether they have released the forecast or not. The forecast, the inflation outlook forecast over here. Okay, let's go to the BOJ website. Okay, let me refresh it. Okay, they haven't come out yet because it's sometimes very slow. Okay, nothing. The thing is not out yet. Okay, so I can't share. So let me see if they have anything. Monetary policy releases. Okay. Oh, statement. Okay, so this is the statement over here. Okay, so now it seems to outlook. Yeah, this is the outlook for economic activity and prices. Okay, good. So they have already released the April one. Okay, so let's have a quick look. What's their forecast like, right, for next year? Okay, because this is quite important. It actually guides the trajectory of the potential rate hike. Either in. Okay, so let's go down immediately over here. Okay. So yeah, this is the fiscal year. Okay, so no change. So okay, so this for this year, fiscal year 2024. So the box here, right, was forecast made in January. That means what they release every quarter, January 24. So the median one was 1.9%. So this time round, they also maintain at 1.9%. Okay, initial market expecting 2%. So this very likely due to the softer Tokyo CPI data that was released earlier this morning that we discussed in our daily dose right earlier on. Okay, so that also actually explained to us the strong movement in the dollar yen breaking above 155.70 earlier on. Okay, so next fiscal year at 2025, they also no change at 1.9%. Okay, 1.9% now. No change previous from the forecast that was made earlier in January 2024. So this time round, they released the fiscal year 2026. Well, so they sounded quite confident. They expect longer term inflation data to come into longer term inflationary trend to actually slowly tick upward is Japan. So they have it at 2.1%, above Bank of Japan usual target of 2%. So it seems to us that they are actually having a very kind of slowly mode of monitoring new data before deciding on the next interest rate hike. But based on the forecast of fiscal year of 2026, they do not expect Japan to actually inch back to a deflationary mode, because they seems to me that the projection is at 2.1% for fiscal year 2026 in terms of the CPI trend, that is excluding fresh food and energy, to maintain it at around that 2% BOJ inflation target. But in the short term, over here, it seems to me that the current stance is still supporting a strong dollar against the Japanese yen, at least in the short term. All right. So the next thing to look out for will be definitely Bank of Japan Governor Yuda's press conference that is going to be out later around the close of the Japanese stock market. So that's between 2:30 p.m. and 3:30 p.m. Singapore time, around this level. Okay. So before we go, right, what other data to look out for today? Definitely for sure will be the all important core PCE price index data that's going to out later in the US. So this is the monthly one for the month of March, 8:30 p.m. Singapore time. So market is expecting right now a slight uptick after after much more rosier surprise Q1 hotter data that was released yesterday. Slight uptick to 2.6% year on year from the previous month of 2.5%. All right, so that's about it for today's daily dose of market insights. And with that, do have a great weekend ahead, and we shall speak again on next Monday. Take care.